Hey there, I am John Howard, and in today's short video, I am going to cover the subject of the $35 trillion home equity gold rush. Wall Street came for U.S. single family neighborhoods, and they're still going here. In case you haven't seen, I actually did a video on this. It's called the Rise of the Institutional Landlords, and I also did some posts on it. But now they've identified another gigantic opportunity, the $35 trillion in U.S. home equity that's essentially sitting entirely untapped. For context, stock market value at the end of 2024's all-time highs was roughly approximately 62 trillion. And then the stock market value during the there was, obviously some stock market crashes in March and April. And that was roughly approximately 52 trillion. So as you can see, it's an extremely large opportunity, the home equity that's sitting there. Before I get into the details, I'm going to give you a little quote. Every person who invests in well-selected real estate in a growing section of a prosperous community adopts the surest and safest method of becoming independent, for real estate is the basis of wealth. That is Theodore Roosevelt, U.S. President. After the single-family rental boom dominated the last decade for Wall Street, institutional investors like Blackstone, KKR, Barclays, and the Carlyle Group have found a new strategy. Instead of buying properties and renting them out, they're now buying into the upside of homes through home equity agreements. What are home equity agreements, you may say? Well, unlike traditional HELOCs or home equity loans, HEAs offer homeowners lump sum cash up front. Typically, they'll go up to 65 to 70 LTV total. So obviously, if you have a mortgage, a first mortgage or a second mortgage, they'll go up to that 70 maximum. There's no monthly payments or interest rates. There's no debt on your credit report. And then another thing to add is that some of these groups will actually consider a third. In fact, I'm actually considering that right now. We can get into that later and why, but they will look at you at, for example, if you already have a second on your property, they will consider a third. And then, like I said, they go up to 65 to 70% LTV. So what's the trade-off here? Well, you share a percentage of your home's future appreciation when you sell, or if you can buy them out at any point during 0 or 1 year up to 10 years. Essentially, the owner is selling a portion of their property to Wall Street. Imagine that, right? Wall Street, venture capitalists, whatever you want to call it. I like to say, actually, you're selling it to venture capitalists, right? Because they're taking a pretty big chunk. The math that's attracting Wall Street. Here it is. So here's why investors are flooding this space. It's amplified returns through equity exchange rates. When a home appreciates 3% annually, investors can realize 15% plus annual returns. Even if home prices fall, built-in buffers can protect the investor gains. Major firms have invested billions into HEA securitizations, creating a new pipeline into residential equity that doesn't require property management or tenants. Which homeowners with equity may consider something like this? Well, HEAs work best for homeowners who are equity rich but cash poor, facing temporary financial challenges, unable to qualify for traditional loans. Some of these companies accept credit scores all the way down to 500, a FICO 500, planning to stay in or own their property for the long term. So here's the reality check. While HEAs solve immediate cash flow problems and require no payments, they come with significant costs. A homeowner borrowing $100,000 on $1 million property could end up paying back roughly $305,871 after 10 years if the home appreciates normally, compared to just $120,000 in total payments with a traditional home equity loan or HELOC. And the HELOC figure assumes a 12% interest rate in current times with an average, with an average, or let's say a below average credit score, because it's very difficult for anybody to get any sort of a HELOC or a first mortgage, even a DSCR, if their credit is under, let's say, 640. Here's a couple more catches. So if the property appreciates more than average, like in a great case of the property going way up in value, the actual HEA group gets more, right? They get more because they're effectively buying, they're paying you for a percentage of your home. So if the home goes up, and it goes from $1 million hypothetically to $2 million in 10 years, they're getting hypothetically 15%. So they're getting 15% of 2 million instead of 15% of, the 1.5 million. Then the other catch is if the property goes down in value, they still get a share. Now, obviously their share goes down, but they still get their share if the property goes down in value. You just get a lot less as the main owner. Companies like HomeTap, Point, Unison, and Unlock, there's actually more than that out there, are making these agreements more accessible for homeowners across 29 plus states. Meanwhile, the platforms like HomeShares are opening opportunities for accredited investors to participate in diversified home equity agreement portfolios. HomeShares recently acquired City Funds. I did a little bit of research on City Funds, and City Funds was offering a guaranteed floor of 7% to investors. That's pretty compelling. What I want to tell you is one of my, this is over 20 years ago, but one of my main jobs, post-college, was I worked at SunAmerica, which is now called AIG, but they were acquired by AIG back when I was there. And I was actually a wholesaler. So I was wholesaling their variable annuity products to the wirehouses, right? And they came out with this product called TIP, which is the income protector. They called it TIP. And it offered a guaranteed income of 6%. And what happened was it sold like crazy. And literally after a couple of months, the insurance company went back and they started getting worried that they might not be able to afford the product. They actually canceled it and they never brought it back. Now I was there for, 3 years, which is not insignificant. But the point is that they never brought that product back when I was there. It's called TIP. So, and even that is less than the 6% here. So a guaranteed floor of 7% is very strong. Obviously that's very, very strong. As you can imagine, 7% guaranteed floor. That's almost twice the annual appreciation of U.S. Real estate. 1967 to the end of 2024, which is about 4.24%. So as you can see, that's a very strong floor. So what's the net here? So the net here is that your home equity has become its own asset class. Whether you're a homeowner exploring options or an investor exploring, real estate. The various categories of real estate, understanding home equity agreements is crucial in today's evolving real estate landscape. So what do you think? Why do you believe any property owner would consider tapping into their own home's equity by selling a portion to Wall Street or venture capitalists? My take is that it makes more sense than to sell it, right? Especially if you're in a situation like I described above. You're equity rich but cash poor. You really see the value in kind of not having a payment. But the consideration also depends on how one values not having a monthly payment and the return they can achieve from, provided that they invest that cash and do something with it, right? And then also, lastly, the amortization, paying the loans down, does make it a lot more appealing to consider, because if you look at it over a 10-year horizon, or even like a 3 to 5 or 7-year time horizon, you're going to be paying your loans down. So you can kind of calculate what your loans are going to be paid down. But if you look at the example of what I provided, which is $305,871 after 10 years, I mean, obviously that's a lot higher than the $120,000 that you could have gotten from a 12% HELOC at $100,000. But again, that's a lot of these people, but they might not be able to qualify for that $120,000 HELOC or home equity loan. And on top of that, they might really see the value in not having a payment. I mean, if you think about it. So if you actually do that math and you look at basically that extra 200,000, 205,000, on top of the 100 that they gave you, that's about 20% annualized, over 10 years. So that's a pretty high, interest rate to pay. It's a pretty high, let's say, interest reserve, to have there. So, you better be doing something with that capital, and not just burning it, right? So there you go. And just full disclosure, I'm actually looking at it, on my own. Like I said, I'm looking at, one of my places doing a third, because it's really not that common to actually be able to get a third unless you're like a real estate investor and you're doing, hard money, private money, you're doing a flip or you're doing construction. Sometimes they'll do a third, but it's pretty uncommon to do a third. But the point is that not that many places do a third, and you can kind of access that equity in your home, to go put it to work to, go get another property or to, start, another business or maybe fund a new venture kind of thing, right? But at the end of the day, if you're going to be paying 20%, you better be making use of that money, because it's not going to be that easy to achieve 20%. Now, what I will say is one thing I am considering: premium short-term furnished rentals, and not in California. So like a 1 to 4 hour drive from like a major metropolitan area, like somewhere on the East Coast or Southeast. And that's kind of a high capital requirement, but at the same time, it is, those are seeing about a 20% cash on cash return, which doesn't include depreciation, doesn't include the tax benefits, doesn't include the amortization, all that stuff. So that's the sort of thing where it would make sense, provided you could achieve that 20%. Everybody, hopefully, if you liked this video, you can consider giving it a like. You can consider subscribing to my channel. I've been talking a lot about real estate. I do talk about more than just real estate, but I have been kind of focusing my content lately on real estate. I actually have been doing short and medium term rentals for literally the last 2 decades. And, meanwhile, during that time, I actually have owned or managed 5 different short and medium term furnished rentals. And also during that time, I launched and operated 4 different businesses that went up to 7 figures plus per year. So it's definitely manageable, definitely something that you could do where you could kind of, add some properties to the mix and, get them going and do medium-term rentals or long-term. You could do long-term rentals, of course, but, medium-term furnished rentals is a better way to kind of, qualify for the loophole in taxes where you get, active material participation and get some very good tax benefits, right? But anyway, so the fact is that, if you like this video, like I said, you can give it a like. You'll see some links in the description area. So if you are interested in real estate investing, I have something I call the SMTR Launch Kit, Short and Medium Term Rentals Launch Kit. It's really very simple and basic, not expensive at all. If you're looking to connect with or learn with somebody that might be a little bit further ahead of you, you can go check that out. Also, you'll see my email in the description area if you want to email me. I've got some very super basic coaching, again, email coaching. If you want to check that out, again, that's something that if you see the value in working with someone that might be a little further ahead of you. Hopefully you like that, and have a great day.